Imagine that you are a merchant standing beside a Mediterranean harbour 600 years ago. Almost everything you own sits in one ship. The hull carries wool, oil, wine, silver, and goods purchased with money borrowed from relatives and business partners. If the ship returns, the sale could make you rich. If pirates capture it, a storm drives it onto rocks, or fire destroys the cargo, years of work disappear before you even hear the news. There is no insurance company to call. There is no customer service desk, no emergency payment, and no government promise that someone will rescue your business. Your fortune sails beyond the horizon. 3 months later, another vessel enters the harbour. Its captain brings the message you feared. Your ship never reached its destination. Now a simple question decides the future of your family. Who pays? The answer reveals that insurance existed long before the insurance company. People had always faced dangers too large for one household to absorb. Harvests failed, warehouses burned, breadwinners died. Animals became sick, caravans were robbed, ships vanished. Communities therefore developed ways to share losses, forgive obligations, pool contributions, and transfer danger to people able to carry it. These arrangements did not all look like modern policies, and it would be misleading to call every act of mutual aid insurance. Yet each solved a piece of the same economic problem. How can many people convert one person's unpredictable catastrophe into a smaller, predictable cost for everyone? That is the basic bargain behind insurance. You agree to lose a little money with certainty so that you do not lose everything by chance. The payment is small enough to survive. The possible compensation is large enough to rebuild. The person accepting the risk expects that most customers will not suffer a loss at the same time. If 100 merchants each contribute a small amount and only one ship sinks, the common pool can compensate the unlucky owner while the other 99 continue trading. But if 20 ships sink together, the fund may collapse. Insurance is therefore not the removal of risk. It is the organization, division, and pricing of risk. Before anyone could organize it, the oldest defense was self-insurance. A farmer stored extra grain for a failed harvest. A merchant kept silver in reserve rather than placing every coin in trade. A herder spread animals between different pastures. A shipowner owned fractions of several vessels instead of one whole ship. Nothing was paid to an outside insurer. The owner simply sacrificed current profit to create a private cushion. Self-insurance was reliable because it did not depend on another person's promise. It was also expensive. Silver locked in a chest could not finance another caravan. Grain kept for emergencies could rot. A family wealthy enough to survive one bad year might be destroyed by 3. Most importantly, a reserve large enough to replace a house, ship, or lifetime of cargo had to remain idle, even though the disaster might never happen. The safest merchant could become the least productive because so much of his fortune waited for a catastrophe. Diversification improved the bargain. If a merchant divided his goods among 5 ships, one wreck no longer destroyed the entire cargo. If investors each owned small fractions of several voyages, losses could be spread across many fortunes. But diversification had limits. 5 ships might sail in the same storm season, pass the same pirate-controlled coast, or be seized when war suddenly closed a port. Poor merchants could not afford pieces of enough ventures to spread danger widely, and even a diversified merchant still carried his own losses. He had reduced the chance of ruin, not transferred it. Communities offered another answer. Families, temples, burial societies, religious groups, guilds, and neighborhoods could collect contributions or promise help when a member suffered a recognized misfortune. The support might pay for burial, assist a widow, replace tools, provide food during illness, or rebuild after a fire. These systems rested on repeated relationships. Members knew one another, watched behavior, and could punish someone who made a dishonest claim. Trust performed part of the work later assigned to investigators, contracts, and regulators. Mutual aid protected people who could never build large reserves alone, but it was usually limited to a group and a narrow set of needs. Payments might depend on custom rather than a legally enforceable promise. A local fund could handle one death or one damaged workshop. It could fail when disease, invasion, or fire struck the entire community. When every contributor needed help at once, there was nobody left outside the disaster to refill the pool. The great challenge was not merely sharing risk. It was sharing risk with people whose disasters were unlikely to happen at the same moment. Ancient law also moved losses between debtors and creditors. One provision associated with the Code of Hammurabi says that if a storm destroyed a debtor's grain or a lack of water prevented production, the debtor did not owe the year's grain installment. This was not a modern crop insurance policy. The farmer had not necessarily paid a separate premium into a company, but the rule placed part of an uncontrollable agricultural loss on the creditor instead of forcing the farmer to carry it alone. The obligation changed when nature made repayment impossible. Sea trade made that transfer more explicit. A conventional lender advanced money and expected repayment with interest whether the merchant's voyage succeeded or failed. That could leave a ship owner ruined twice. First, the cargo vanished, then the debt remained. Maritime loans developed a different condition. Under arrangements known in various forms across the ancient and medieval trading world, the lender advanced capital for the voyage, but accepted that repayment could depend on the ship's safe return. If an agreed maritime danger destroyed the venture, the borrower might owe nothing. If the ship arrived, the borrower repaid the principal plus a large additional amount. This arrangement is often described through the idea of bottomry or the sea loan. Its logic combined credit and insurance inside one contract. The merchant received money to conduct the voyage. The lender received a high return if the voyage survived. In exchange for that high return, the lender accepted the possibility of losing the principal. The merchant still lost time, expected profit, and perhaps part of his own cargo after a wreck, but he did not also face the full loan repayment. Some of the maritime risk had moved to the lender. Consider the calculation. A lender could place 100 silver coins into an ordinary secured loan and expect a modest return. Or the lender could finance a dangerous voyage and demand a much larger return if the ship came home. The difference was not simply greed. It was the price of accepting a chance that nothing would come back. The lender needed enough successful voyages to cover the occasional complete loss. If the price was too low, a few storms erased years of gains. If it was too high, merchants refused to sail or found another financier. The sea loan was ingenious, but it was not yet a clean insurance policy. The protection was bundled with financing. A merchant who already possessed enough capital might want protection without borrowing money. A lender who wanted interest income might not want exposure to storms and pirates. Combining the two made the contract harder to price because the lender had to judge both the borrower's honesty and the voyage's danger. The next breakthrough would separate the money needed for trade from the money paid to transfer risk. Sailors also followed a different rule for a very specific emergency. Imagine a ship caught in a violent storm. The vessel will sink unless the crew throws part of the cargo overboard. If the captain sacrifices one merchant's goods and saves everyone else's property, should that one merchant bear the entire loss? The ancient maritime principle, later known as general average, said no. A sacrifice made deliberately for the common safety should be shared by those whose property was saved. The economic logic is powerful. Without sharing, every cargo owner would resist throwing away his own goods, even when sacrifice could save the ship. The captain might waste precious time arguing while the vessel filled with water. If the loss is divided proportionally, everyone has less reason to block the decision. One owner loses the physical cargo, but the financial burden is spread among the participants in the voyage. For centuries, merchants combined these tools. They kept reserves, split cargo among ships, formed partnerships, used maritime loans, relied on kinship networks, and shared certain emergency losses. The system enabled trade, but every solution remained costly or incomplete. The merchant might need credit but not insurance. The lender might accept the borrower but dislike the route. The richest traders could diversify. Smaller ones remained exposed. Informal help could be generous but uncertain. What commerce needed was a separate promise that could be purchased for a known price. That promise emerged clearly in the commercial cities of medieval Italy. Documentary evidence shows premium-based marine insurance policies in Genoa by at least 1347. Instead of lending the merchant the value of the cargo, an insurer could promise to pay an agreed sum if specified dangers caused a loss. In return, the merchant paid a premium at the beginning. The financing of the voyage and the protection of the voyage became separate transactions. This separation changed everything. Suppose the cargo was worth 1,000 coins. The merchant could finance it with personal wealth, a partnership, or an ordinary loan. Separately, the merchant could pay a much smaller premium to someone willing to cover part of the value against named maritime perils. If the ship arrived safely, the insurer kept the premium. If the covered disaster occurred, the insurer owed the promised compensation. The insurer did not need to supply the cargo capital, and the merchant did not need to borrow simply to obtain protection. The merchant had exchanged a small certain expense for protection against a large uncertain loss. The insurer had accepted a large uncertain obligation in exchange for many small certain payments. Both sides could benefit, but only if the premium was sensible and the promise credible. Pricing the promise was the hardest part. Medieval underwriters did not possess satellite forecasts, global loss databases, or computer models. They relied on commercial intelligence. What season would the ship depart? Was the route exposed to storms? Were pirates active? Was war likely? What type of vessel carried the cargo? How old was it? Who was the captain? Which ports would it enter? Was the cargo fragile, flammable, illegal, or unusually tempting to thieves? How long would the journey take? Had similar ships returned safely? But experience could deceive. A route might appear safe only because no great storm had occurred during the underwriter's short career. 10 profitable policies could encourage a merchant to accept larger risks just before a catastrophe. News traveled slowly, so an owner might seek insurance after privately learning that danger had increased. The person buying protection often knew more about the ship than the person selling it. This is the problem now called adverse selection. If insurers charge one average price, owners of the worst ships are most eager to buy, while owners of safer ships may decide the premium is too expensive. The pool gradually fills with dangerous risks. Claims rise, premiums rise, and the safest customers leave again. Without a way to distinguish good risks from bad ones, the market can destroy itself. Another danger appeared after protection was purchased. An uninsured ship owner had every reason to guard the vessel because the loss would be personal. A fully insured owner might become less careful, overload an aging hull, hire a cheaper crew, or even arrange for worthless cargo to disappear while claiming it had been valuable. Insurance could change the behavior it was trying to measure. This is moral hazard. It explains why an insurer cannot simply promise unlimited payment after any bad event. Contracts define covered dangers, exclude misconduct, require evidence, and may leave part of the loss with the customer. If the merchant retains some risk, the merchant still has a reason to protect the ship. If compensation cannot exceed the genuine value lost, destroying property cannot legally create a profit. The design of the policy becomes a system of incentives, not merely a promise of money. Fraud made valuation especially difficult. A ship and its cargo disappeared beyond observation. The owner could exaggerate what had been loaded. The captain could secretly sell goods in another port. Several policies could be purchased from different underwriters for more than the cargo was worth. A real storm could hide a dishonest transaction. Insurance therefore required documents, testimony, port records, bills of lading, correspondence, and trusted agents. The claim had to turn a distant event into believable evidence. The underwriter faced a mirror image problem. The promise might be worthless. A wealthy merchant could accept a premium, sign a policy, and then refuse payment after a major loss. A risk seller could insure more ships than his fortune could possibly cover. There was no value in buying protection from someone who disappeared when disaster arrived. Reputation and capital were therefore as important as the wording of the contract. The customer was not only asking, "What could happen to my ship?" The customer was asking, "Will this insurer still be solvent when it does?" Insurance works best when one underwriter accepts many risks that are not closely connected. A storm in the Western Mediterranean should not sink a ship in the Baltic. A pirate attack near one coast should not burn a warehouse in another city. premiums from the many surviving ventures can pay the few losses. The larger and more varied the portfolio, the more predictable the total result may become, even though nobody can identify in advance which customer will suffer. This is why the economics of insurance differs from ordinary selling. A baker receives money and hands over bread today, the transaction ends. An insurer receives money today and may owe an unknown amount years later. The premium can look like profit long before the true cost is known. A reckless underwriter appears successful during quiet years because almost every premium remains untouched. Only the catastrophe reveals whether the price was adequate and whether enough capital was kept in reserve. Early marine insurance was often written by individual merchants rather than a corporation with a giant balance sheet. A wealthy trader understood shipping and might accept portions of other people's risks alongside his own business. One voyage could be divided among several underwriters, each signed for a stated amount. If the ship was lost, no single person necessarily carried the entire claim. But fragmented underwriting increased coordination costs. The merchant or broker had to find enough credible people, negotiate a price, collect signatures, and later pursue several payments if a claim occurred. Underwriters needed shared rules for interpreting the contract. Disputes required arbitration or courts familiar with merchant custom. A market could grow only where information, expertise, reputation, and enforcement gathered in the same place. The model remained vulnerable because private fortunes were finite. An underwriter might write many policies without revealing the total exposure. A merchant could appear rich, while his capital was already promised against ships still at sea. When several losses arrived, the promise chain broke. The customer had transferred risk legally, but not economically, if the underwriter lacked money to pay. Then fire demonstrated the problem on land. In 1666, the Great Fire of London destroyed a vast part of the city. Houses and businesses stood close together, many built with combustible materials. A flame did not respect property lines. One building's danger became the street's danger, then the neighborhood's danger. The disaster showed why local, mutual help, and private reserves could be overwhelmed by a correlated event. Rebuilding created demand for a more organized market in fire protection. Nicholas Barbon, a builder and economic writer, established an office for insuring houses in 1681. The idea was not simply to compensate owners after a fire. Insurers had an economic reason to reduce the probability and size of fires before they happened. Safer construction could justify a lower price. Inspection could identify dangerous buildings. Private fire brigades and fire marks later became visible parts of the developing system. At almost the same time, London's expanding maritime trade created a famous meeting place for risk. Edward Lloyd's coffee house in Tower Street was being referred to by 1688. It attracted ship owners, captains, merchants, and men willing to insure voyages. The coffee house did not begin as a giant insurance corporation. Its advantage was information. People brought news of departures, arrivals, cargoes, wars, pirates, and ships overdue at sea. In a world where a rumor could be worth a fortune, reliable news improved pricing. A merchant seeking cover could describe the ship and voyage. Individuals willing to accept portions of the risk could write their names beneath the terms and state how much they would cover. That act of writing under the description gave the market its enduring language, underwriting. The room transformed scattered private judgment into a marketplace. One man believed the voyage was safe at a low premium, another demanded more. A third refused, because he had already insured several ships on the same route. Prices emerged from competing views and private information. No single underwriter needed to finance the whole policy, and no shipowner needed to search the entire city without help. Lloyd understood that the most valuable product in the room was not coffee, it was knowledge. The establishment cultivated shipping intelligence, and Lloyd's name became associated with a place where maritime information and insurance could be obtained. By 1691, the coffee house had moved to Lombard Street, nearer the centre of London's commercial world. Later shipping publications and a more formal subscription market strengthened the network. Insurance expanded trade because it changed the worst possible outcome. Without protection, A rational merchant might reject a voyage that was profitable on average because one wreck would destroy the family. With credible insurance, the merchant could exchange part of the expected profit for survival after disaster. More ships could sail, more credit could be offered, and more investors could participate without placing their entire fortunes at risk. Insurance also reduced the price of credit. A lender cares about the chance of repayment. If the cargo securing a loan can vanish without compensation, the lender demands a higher return or refuses the deal. If a credible policy protects the cargo, part of the lender's risk falls. The interest rate can fall, the merchant can operate with less reserve capital, and the same amount of wealth can support more trade. But the industry did not merely support peaceful exchange. Marine insurance became entangled with empire, warfare, privateering, and the transatlantic slave trade. Insurers covered vessels and cargoes within commercial systems built partly on coercion and human exploitation. Risk transfer helped capital enter ventures that individual investors might otherwise have considered too dangerous. The same mechanism that could protect a small merchant could also make brutal enterprises easier to finance. As insurance moved from ships to houses and lives, pricing became even more difficult. A voyage has a departure, route, cargo, and expected return. Human life has no fixed schedule. Early life insurance could resemble a wager when one person purchased a policy on another person's death without a genuine financial relationship. The buyer might profit when the named person died, creating disturbing incentives and turning insurance into gambling. For life insurance to become stable, underwriters needed two things: rules defining who had a legitimate interest in the life being insured, and evidence about mortality across groups. In 1693, Edmund Halley published a life table based on mortality information from Breslau. Such work helped show how the uncertain lifetime of one person could become more predictable when many lives were observed together. Nobody could say exactly when one 30-year-old would die, but a large pool could be priced using patterns. The premium must cover more than the average claim. It must also pay for investigation, administration, fraud, disputes, and the cost of keeping capital ready. It must compensate the risk bearer for accepting uncertainty. If premiums exceed claims and expenses over time, underwriting produces profit. If claims exceed the money collected and reserved, capital absorbs the difference. If capital runs out, the promise fails precisely when customers need it most. Before large insurance companies, the capital might belong to individual merchants, partnerships, mutual associations, or small offices. Each form solved a different trust problem. Individual underwriters offered expertise and personal judgment, but could die or become insolvent. Mutual groups aligned customers and owners because contributors shared the result, but they could be concentrated in one trade or region. Permanent companies could collect larger capital pools and survive beyond one person's lifetime, but managers might take risks that distant owners and customers could not see. The rise of insurance companies was therefore not the invention of insurance. It was an attempt to make the promise more durable, scalable, and impersonal. A policy no longer had to depend entirely on the continuing wealth and reputation of one merchant. A firm could maintain records, hire specialists, diversify across many contracts, hold reserves, and continue after founders retired or died. Capital became organized behind the promise. Yet the ancient problem never disappeared. Every insurer still receives certain money now in exchange for an uncertain obligation later. Every premium still reflects a judgment about frequency, severity, behavior, information, and correlation. Every customer still wonders whether the institution will pay. Every institution still worries that the customer knows something it does not. Return to the merchant whose ship vanished. Without any protection, the wreck ends his business. With diversification, it destroys only part of his fortune. With a maritime loan, the lender may absorb the lost principal. With general average, a deliberate sacrifice could be shared among those saved. With a premium policy, underwriters compensate an agreed portion of the covered loss. Each step moves the merchant farther from total ruin, but each requires someone else to carry the danger. Who pays when the ship sinks? Ultimately, many people do. Surviving merchants paid premiums. Underwriters committed capital. Investors accepted lower profits to build reserves. Customers paid for inspections and administration. The unlucky loss was converted into thousands of ordinary transactions that happened before and after the storm. That conversion was the true invention. Insurance did not defeat storms, fires, disease, piracy, or death. It changed their economic shape. A catastrophe that once destroyed one household could be divided into small costs spread across a community of strangers. A risk that once trapped wealth in idle reserves could be priced, traded, and carried by specialists. A promise that began among relatives and merchants could grow into a permanent institution. Long before glass towers, call centers, and global insurance companies, the essential machine was already operating. Gather many contributions, separate risks that can be pulled from dangers that strike everyone together. Learn more than the fraudster. Keep the customer interested in preventing loss. Charge enough to survive the rare disaster. Hold enough capital to pay when experience turns out to be wrong. And above all, make the promise credible before the ship disappears.